Hey traders, let's take a moment to thank and feature one of our top sponsors, FX2 Funding. If you're looking to get funded, listen up. FX2 is offering traders the chance to trade with up to $200,000 in simulated capital and receive up to 85% of their results. If you're interested in getting started, use the link being dropped in the chat or the link down in the description below. If you pass the evaluation, you'll receive your feedback and gain access to your new account. FX2 allows traders access to a wide range of assets and allows traders to hold their trades over the weekend. FX2 is giving A1 Trading Show fans 15% off the evaluation fee if you use promo code A1Trading15. So if you'd like to learn more, again, use the link being dropped in the chat or the link down in the description below and use code A1Trading15 at checkout for a discount on any of their evaluations. Now back to the show.
Hey Chris, how you doing?
What's up, Frank? How are you, man? Good morning.
Good morning. Well, I was just here to say hello and welcome everybody else that's watching the live stream today. Today, Nick is out of office and Chris is going to take a look at the charts today. And yeah, I didn't want to take up your live stream time, but I just want to say hey and let you know that the stream is yours.
All right. I appreciate it. Thank you so much. Happy Valentine's Day to all the traders out there and you. Yeah, I mean, welcome to stick around. If you want to collab and chat, that's fine. I'm curious what your reaction was post CPI in the market yesterday. Today seems to be, the market's fighting back a little bit. I had a lot to discuss as far as positioning. I want to look at the Edge Finder and where I'm at for options today. So you want to stick around for a little bit?
Yeah, I'll stay for a few minutes and just give my take on CPI. Honestly, core was my main concern. So seeing that higher was not a great sign for me on the index side of things. However, you take a look at expectations, everything beat expectations, but CPI on the month over month was unchanged, and then the benchmark came in actually lower than the previous month. So although we beat expectations or we beat the previous month, we went higher than what we were expected. So it is kind of mixed. I'm aware that core is the Fed's primary tool of inflation, but I think as far as consumers are concerned, the food and energy are very important in the average person's life. So seeing year over year, month over month, either unchanged or lower is still a good sign. And the fact that we're looking at an uptrend in all the indices in the U.S. so far, still haven't broken. The NAS has not broken a strong trend line since I think the trend started in late October. So I think until we see otherwise, I wouldn't necessarily look for high leverage positions to the long side, but I think, it's still in an uptrend. So until it tells me otherwise, I think I'm still bullish. So
yeah, I agree. I think that, there's a nice milestone with the S&P hitting 5,000. I really thought that we might have that melt up until the Dow hits 40,000. So, the one thing that we were noticing in position wise is a lot of retail traders were getting short on the S&P, getting short in the markets. And as we saw and discovered with the commitment to traders and the big net shorts we saw in October of last year, they were dead wrong. And they were wrong in a big way when the market rallied as hard as it did through that bottom in October, November, December. And so I think that the one thing that we switched the corner on or turn the corner on in 2024 is the narratives from these companies, like earnings wise, has been way different. There's a lot more excitement about AI language, and you're starting to see that drip into more tech and more broad stocks. You're starting to see ridiculous runs. I mean, I don't know if you had a chance to check out the trading battle last night when I was on with Boris Schlossberg and Blake Morrow, but we looked at SMCI, and this chart is absolutely insane, right? I mean, even today, SMCI has gapped from 792 up to 822, and it's up another, $63 on the day from yesterday's close, which is insane.
That is,
Honestly, this to me, it feels like GameStop. I don't want to. I mean, it's an $800 stock. It's certainly not GameStop, but it's like, this is insane. I have not seen a chart do this since a GameStop, since a Bitcoin. That just somehow this either is the greatest thing ever, or this is all going to end badly, but still be like one of the best performing stocks of the year. So we definitely have some wonky stuff going on in the markets right now.
that's very true. Are you in any of this? Did you have any
I have
positions on this?
credit spreads. I'm doing like very safe out of the money credit spreads where I collected like $1, $30, $40 out of a $5 spread on SMCI and Nvidia. So I'm getting some of that exposure where I don't want to call the top. I'm not interested in that. I'm not trying to get long and chase I mean, if let me look at an option trade here for SMCI, because I'm pretty sure just going long, couple things. Oops, I got to log back in. Couple things I would be looking at as far as getting long would be, if you're getting long options and you're paying for that option, how much is it? And what do you have to get? What do you have price to, or what does price need to do to get profitable? So if I just looked at SMCI here, let me get logged in. No options available for this symbol. That should not be the case. That's really strange. Did they just deactivate options trading? Hang on a second here. Let me search for SMCI. So right there, add it in.
Would you mind explaining what a credit spread is?
Yeah, not at all. Not at all. This is wild. I might log into another broker platform then if this is, let me figure something out here. And then absolutely, let's talk about it. So let's go. I'll log in on another screen. Just give me a second. Let's have, this would be a great lesson because this is one of my favorite trades. And how about this? How about I take, my live session today? Let's do a little options 101. I actually have a video series on my YouTube channel about this where, you can go into like all these other options, education, lessons, and it'll show you these complicated like profit risk probability curves, and it'll give you these weird vertical axis, horizontal axis that sometimes it makes sense, sometimes it's just not very intuitive. People talk about Greeks. All it really means is there's a pro and a con to everything that we do in options. That's what I love about the market. You can define your risk really easily. So I'll walk through a couple of strategies if you want to. So let's talk. Let me first make sure that I'm not missing anything here, because if they discontinued options, that'd be insane. Let me go to Thinkorswim.
I used to have an account on Thinkorswim, and then I got transferred to Schwab. I don't know if that has anything to do with it.
Well, the platform, so Thinkorswim should be the platform you can still use, but everything is going under it's going to be under Schwab.com. So Schwab bought TD Ameritrade, but Thinkorswim is going to be their platform. I used actually Street Smart Edge for the last like 5 years. That's a great platform. That's kind of, it's a little bit more retail friendly, more intuitive off the bat than Thinkorswim. But Thinkorswim for retail traders and Tasty, two of the best platforms I've ever used for options. Let me go into this here, log in, see if I can get. Okay.
So my knowledge of options in general is very limited.
That's okay. Well, use today as a crash course then.
Yeah, I will be listening.
I hear Nick talk about like I sold some puts. It's like Nick's got the classic Buffett style, which is cash secured puts. So you can just sell a put, collect some premium. If price comes back to you and you get filled at a price you want, that's a great place to own a stock. Cash secured puts cost a little bit more money. So I think credit spreads are a good way to get started with small accounts. So let's talk about this. I'm really weirded out by this SMCI thing. Let me go to Nvidia really quickly. So there's my positions, options table, SMCI.
Wow. So you were in Nvidia as well.
Yeah. So I've got Nvidia. And again, I'm doing this with just safe credit spreads. Now we have SMCI. Okay. So now I can continue on with what I was talking about. If I wanted to go out and say, right now we're looking at the 16th for an expiration 2 days out. If I want to go, kind of my long options, if I want time to work in my favor, I'm probably going to go out about 30 to 40 days. I just want to show you how expensive this trade would be. So if we're going to do a long call and you're like, SMCI is going to $1,000, I know it. Well, then you want to go out to get yourself some time. So you go out about 40 days or so. And right here, We're trading at current price is $800 and some dollars. I'm not even, this is just weird. I'm not getting a live feed. Okay, so we're 865. Let's talk about this. If I did a long option, okay, so we're gonna talk options 101 today for this session. So if we did a long option, and you can have a long call, and again, I'm not trying to talk above anybody here. Some of the language is really silly. I always joke about how stupid the strategies sound. For example, Frank, if you're interested, we trade iron condors and we trade jade lizards and we trade, calendar spreads and blah. It doesn't matter. All that matters is like if I tell you what happens in the trade, you will understand it. So today, before you leave, I want you to understand what a credit spread is. It's really simple. And so a lot of traders just do this. This is where a lot of traders get burned. Okay. Long options. So you can do a long put. Okay. Now let's talk about what the market does. What the market does, right? Market goes nowhere. Market goes up a little. It goes down a little. It goes up a lot. And it goes down a lot. Correct? That's about all the market can do. So for us, if we are long an option, we are also, remember, paying for that option. So if we're long an option, we're going to be paying for that, which is going to be, we pay for the option, and that fancy word for paying for it is a debit. We pay for the option, and that is a debit. Now, in order for our long option to be profitable, let's say that we pay, let's use SMCI as an example. All right. So SMCI as an example. Where's my text box here? So SMCI is trading at $867. Okay.
Okay.
So again, and I always preface this with like the names are silly, but an at the money, hopefully this makes sense. At the money is current price. So around 870 is at the money. Okay. If we're in the money, that means that if we're doing a long option or we're doing a call option, in the money means that price is already, it's already been at that price. So an in the money option would be, let's say 850. 850 would be considered in the money, or 800 is pretty deep in the money. So we'll do, let's say 800 is way in the money. The 870, this is right around 870, and then we can go out of the money. Okay. And again, these names are silly, but it is what it is. That's probably why, options started off with like Wall Street's little secret, but an out of the money might be like a $900 to $1,000, which means price hasn't gotten there yet. But as far as me paying for the option, it's going to be cheaper to buy an out of the money option that anticipates price gets there and that option gains in value. And in the money option is we're paying more for that, but we have at least a head start where our option's worth something with the real value. They call that the intrinsic value, is at least worth something. At the money is, you want to see what SMCI is charging right now. I would not be surprised if this is like a $50 to $100 option. So before, I know you're jumping in there in a sec. Let's say that an at the money option right now is $100 debit for a long call. Okay, let's just say that's the price. That means that if I buy an at the money call on SMCI at $870, that's the strike price. $870 is the current price. Spell that right. That is the current price. And I pay $100 premium for the long call. Now we can do simple math. So what's 870 plus 100?
Is this a rhetorical question?
No, you know the answer. What's the answer?
Yeah. Okay. So 970.
970 is where we need price to be for our option to be profitable, right? So even though we're buying an option at the money, because we pay that premium, we need price to not only keep going higher, we need price to keep going higher to cover the cost of the option. So when I say what the market does, it goes nowhere, up a little, down a little, up a lot, down a lot. We actually need this market to go up a lot just to cover the cost of our option, which is why most traders lose when you're buying options. When you're long an option, when you're long a put, long a call, most traders lose because you need that directional play to not only cover the movement in the stock price, but you needed to cover the premium that you paid as well. And that is why most traders lose on long options. If you flip that around as a seller of the option, all I need price to do is go nowhere, go up a little, go up a lot. I can make money in all three of those scenarios. Okay. Also, if price goes down a little, maybe even down a lot, depending on how I position my credit spread, for example, I can still make money. So I think this translates into, here's how we get into credit spreads. Okay. So right now it's trading at 870. I have no interest in being close to this price. Okay. So what I want to show is, if I delete this for a second, let me see if I can delete these. There we go. There we go. Let's go into the options chain here. And this is being really silly for some reason. Let's see if I can get an expected move. All right. My platform is being a little strange, but let's just go look at a different strategy. Let's just look at a vertical spread and clear this out. Okay. So right now, the one thing I'm going to look at, and again, not to be confusing, but this is just a simple options chain. You can pull this up on any publicly traded stock that has options. We have daily expirations on the S&P, daily expirations on the NASDAQ. We have weekly expirations on the Dow Jones. We have every other day, so like 3 days a week on the Russell. That's what's provided a lot of liquidity for options. There's a lot of volume. I mean, single day options right now is about 40 to 45% of daily options, or all of the options right now are daily and single days, which is crazy. But most stocks have weekly options as of now. So if I come into SMCI, and the one column I'm going to look at here, if you can see this, is it's a delta column. And all that tells me is if I go at the money, which we know that price is trading around 870, anything that's at the money is going to be around a 45 to 50 delta. Just for lack of better terms, like that's what it's going to be. That's at the money. I'm not interested in flirting with at the money. I'm going to give myself all the freedom to say if price goes up a little or up a lot or down a little or goes nowhere, I can make money in that trade. So if I were to position myself for a credit spread on SMCI, I would be looking to see on the put side. So I've got calls on the left and I've got puts on the right. I would go down in price. So you see me navigating the options chain here. I'm going to go down in price until I see about a 20 delta or less. So here's my negative 21 delta. Here's a 15 delta. Now this is a good price point. If all I did was a credit spread right here, which means I sell the 800 put and I buy an 800 put, it's a $5 spread. Okay. Now that $5 spread, if you see this right here, it shows that I can collect about $1.25 in credit right now. Okay. So let's do the math on that. This is what's nice. You're really just doing addition and subtraction in options. So if I did an 800 by 795, and all that means, if anyone's like, what does that trade mean? I do a sell to open 800 put, and I do a buy to open 795 put. Okay. Now this is a credit spread because this I can afford to trade. This means that, let's see if I can go back into this here.
So credit spread is selling and buying a put.
Correct. You're creating a spread with the different strike prices. So a credit spread is you would sell the 800 put, and if you think about this, what does it mean if I just sell the put? So if I just sell the 800 put, you're going to see that I can collect a lot of premium on that, but I am on the hook. If SMCI drops down to $500, that's a $300 price point below my sell put. Now, what I'm doing as an option seller, if I sell the 800 put, that means that I am obligated to own the stock at $800. If I get assigned it, I own it $800. Now, I can collect a premium because I'm saying, look, I'll own the stock at $800. But think about that. If I had a stock go just blow through my level, and I can show you what that break even is going to be. So if I sell the put 800 and it's just that's considered a naked put. I collect premium, which is nice. Okay, so I can be given premium and given income essentially to say, hey, this guy wants to own the stock at $800. If it gets to $800 and lower, I could get assigned. But I collect the premium because that's my bonus for saying I want to own the stock. But I am exposed I am exposed all the way. I'm exposed to 0 on any, crazy move. Now, obviously, the likelihood of that is slim to none. But the stock has gone up over, 160% for the year. And we could probably have a 23% pullback or even a 38 to 50% pullback at some point. It gets really violent. And what that translates into a dollar amount, it's probably going to be $50 to $100. So if I'm...
Here's a question.
Yeah, go ahead.
So you're selling and buying a put.
Yes.
There's a $5 difference. So at what point, say what you said happens, it goes down to 500. At what point do you make or lose money because you're buying a put, which will make you money, but you're selling a put, and if you get assigned, you, I guess, collect premium in that amount of time you hold it, but then you'll have to own the shares. So where's the trade-off of doing both? Because, like if you take a long and short position at the same time, say this isn't options, you're basically making nothing. So this looks like in some sort of way a long and short position. So I'm curious, what is the point to where you break even, where you make money, or where you are losing money?
Okay, and I just want to say this. This was not scripted or talked about ahead of time, but Frank just asked like the perfect question to fully explain like why credit spreads are so great. Okay. So the reason I would do a credit spread over just selling an $800 put is because if I sell the $800 put, which gives me the obligation and it gives me I have the right and obligation to own at $800. Okay. Now the reason I do a buy 795 put is because this is what is called defining my risk. So it's a $5 spread. And so this is what's nice, Frank. If the stock went from $860 all the way down to $500, I'm only risking a maximum here of $5 because of the spread. But what did we collect on this? So we have a $5 spread. We're showing that we can collect a $1.25 credit on this credit spread, right? That's what the broker platform's showing. So that means that I have a $1.25 that I'm collecting today. And if I'm right, the price goes up a lot, nowhere, down a little. I collect that $1.25, and that is mine as the options, as a credit spread trader here. That is mine. I collect the $1.25 and I keep the full credit. Now, if price goes below $7.95, that's where we're going to start talking about what's my risk, what's my reward. So I have a $3.75 risk on this trade, right? Because it's a $5 spread, and I collected $1.25. So that's my risk, which means the most I can lose on this trade, if the stock goes to $500, if the stock goes to $1,000, if the stock goes to 0, the most I can lose is $3.75 if it goes below my $7.95 long put. Okay. So what happens, and you're getting into like some pretty good stuff, because if we talk through this example, you should have a good understanding of why credit spreads are great, and also the pros and cons of knowing when price does this, what happens. And that's where most people get lost is, in the event that SMCI drops and goes way below these levels. Remember, this is a buyers and sellers market. There are people that if you are short SMCI and this thing drops $100, most likely those option traders are going to want to get rid of their long puts for profits. And so they're going to, assign that to me if I'm an option seller, right? If I'm doing the credit spread, I can get assigned. So let's say that, again, this is all just example here, but I know that if I take this trade, my max risk is $3.75 because I'm getting paid the $1.25 up front. I have a $5 spread. All I have to do by expiration, and I think we went out, like 30 days or something like that, is by the time that my option contract expires, as long as price is above $800.01, I make full profit on this trade at $1.25. That's all I needed to do. So from a percentage standpoint, if the stock drops, let's go down to $800. So if we drop to $800, which is going to be somewhere around a 9% dip in the stock, I still make money. Okay. If the stock stays where it is, I make money. If the stock goes up 1%, 10%, 1,000%, I still make money. So I have 3 or 4 situations that allows me to make money as this credit spread trader. Now, if the stock drops, let's say that it goes down to 750. All right. And Frank, you're going to answer these questions for me. Okay. So let's say you'll be fine. Let's say the SMCI drops to $750. Okay. You still have the credit spread with the 800 by 795. What's the most you can risk? If you have an 800 by 795, what's the most you're risking on your trade?
Is it not 375?
It's still 375. That's the most you're going to risk.
Okay.
But in the event that the stock drops to 750, and as a an options market that has buyers and sellers, if you get assigned the stock.
Oh, so you'll own it at 800.
Exactly. So let's say the stock drops to 750 and you are assigned at your sell put level. Okay. So you're assigned at $800, just like you said. And remember, you collected a $1.25 premium on the credit spread. Okay. So your break-even price, if you wanted to say, you know what, I'm okay owning SMCI because I think it's going to be, I'll give it a chance to come back. Break-even price is going to be $798.75, right? We take out a $1.25 off that $800. So that's my break-even price. Now, price is at $750. I have a long put option at $795, and current price is $750. So what is the value, Frank? What's the value of my long put option? If price is $750 and my long put option is at $795, what's the value of that stock or that put option?
Is it the difference between those two numbers?
Yeah. So $795 minus $750, that's a $45 value in my long put option. Okay. So in the event that you're like, you know what, I don't think SMCI is going to dip much more than the 9 or 10% or the 15% that it did. I'm ready to own this thing. I think I can own this kind of near the bottom if we start to see a dip from here or a bottom. So we could, and this is what traders have to think about. If we can, number one, afford to take the assignment and own the shares, if I want to keep SMCI, then I have a break even of $798.75. Okay. And then I have a $45 long put credit that I could cash in for. And then what's my new break even? What's my new break even? Again, we're just doing math here. And one thing I haven't found is I've done a lot of options trading. I've traded a lot of platforms. You still have to do it by hand. If I'm doing this type of stuff, you still have to type it out longhand. I could show you guys like notepads of like just handwriting all my little break-even levels and then transferring it into a spreadsheet. But that's kind of the old school way to do it. But it's still, this is what's important. If I own if I get assigned with the credit spread $798.75 and I have a $45 value in that long put, I could actually own the shares, even though the stock price dropped from $876 all the way down to $750. I could own the shares of SMCI following that drop down. I could own the shares at $753.75. So if you wanted to, you could own the shares here. And what are the chances that that stock, maybe jumps up to $765 or jumps up to $775? Probably pretty high. Again, there's risk in trading, right? So maybe it keeps going down and you're going to be holding it there, but there's other stuff we could do. So I'll ask you this, Frank. Do you want to own your shares of SMCI at $753 as opposed to $800, as opposed to, $798? Do you like the fact that you could actually lower your cost basis?
Yes, but I am a little confused still about getting assigned at getting assigned at 800 and then being allowed to own it at 753.
Mm-hmm.
That kind of just went over my head there.
Yeah, let's break it down again. So the reason that remember you're assigned, let me just put another text box here. So you're assigned to 800, right? You did a credit spread. Your credit spread collected the $1.25. So automatically, even if you took the $800 assignment, you're lowering your cost basis by that $1.25 because you have a long put, right? And that's essentially your protection. And that long put has value. Think about how this trade works. The broker doesn't assign you anything at $7.95 because that's a long option. The broker assigns you at $800. So when you look at your platform, if you got assigned, what you're going to see is 100 shares long, $800. You have to remember, and you have to have this written down, that yes, I was assigned $800, but I collected my $1.25 on my credit spread, and I still have an active long put option that's running in my favor. Does that make sense?
Okay. So you're saying it's like owning it at 753.
So if I close, and here's what would happen. If I close, okay, if I close my long put at if I close that 795 long put and I close that for the $45, that's when I would own the shares effectively at that 753, right? Because I was assigned to 800, collected my credit spread credit for $1.25. Let me just type this out as I talk. Maybe it's a little bit easier. So I collect my credit spread, and then the long put protection, I close for $45 credit. This is where we just do the math. So you have $800 assignment minus the credit spread credit, which was your $1.25, and then also your long put for credit, 45? Which is $45. And so that gives you your effective or net break even at 753 and 75 cents. So let's make sure I did the math right there. I think we did. Where's my mouse? There it is. Okay, so let's put that there. And we get assigned to $800. We collected our $1.25. We close out our long put now for another $45. If I did that and I'm now square in my broker platform, I had the assignment. There's no more long put option, right? And I just sit on the shares. I know that my break-even level is 753 and 75 cents. Now, again, what the broker platform doesn't show you is this. It doesn't show that you own it at 753. It shows that you're assigned at $800. So that's the tricky part, is if you don't do the simple math on this, you don't know that you are owning the shares because of the credits you've collected and the long put that actually was profitable for you. And so this is why it's nice. This is a kind of an extreme example because this is a crazy expensive stock. And even if I own the shares at $753, that's 75 grand on 100 on a one contract, right? If it was 753 and it's times 100, if I just have 100 shares to control an option, I need $75,000 in cash. Now I need about probably $37,000, $38,000 in margin, but that's a big account to take that type of position, right? So here's what also happens. Frank, do you have $75,000 to take the assignment?
Nope.
Okay.
Not even.
I don't either, and I don't want to take the assignment. So here's what I do. I don't do anything, right? If price drops to 750 or drops to 700 and it blows through my credit spread, I'm just going to accept the full loss at expiration for 375, and that's my exposure. I lose $375 on one contract. I'm out. If I get assigned, and this happens a lot, so this will happen if the stock's selling off a ton, brokers will assign you because it's an option buyers and sellers market. So I see this all the time, and traders will freak out. If you're ever teaching options, traders panic when it's like, I got assigned SMCI, I'm upside down $40,000. What happened? All you have to do is close out your long put and then close out the shares. So let's talk about that. And this is what I said. You asked a great question to have this be a lesson from start to finish. If you're a credit spread trader, what does it mean? What do you collect? What are the pros and cons of these trades, right? I'm hoping this makes sense, where the pluses are there's like 3 or 4 ways out of 5 you can win. The minuses are you just have to do some basic math and understand that if price goes against you and it goes, inside your strikes or through your strikes and it's in the wrong direction, you just have to know the consequences of that trade. So let's go ahead.
Like conceptually, without any math, you can say that as opposed to buying or selling a put all on its own, a credit spread allows you to cushion your drawdown more, as in your assignment price is where you would basically, I guess, lose value on the put option that you're selling and you're owning at a higher price. But what a credit spread does is it allows you to have more room for that trade to run down. So instead of an $800 assignment, you collect money on your put, and then you basically own it at a lower value than 800. So you're not necessarily losing money, as opposed to if you were to just only do a sell put option.
Yes. If you did a sell put option and price did, in this example, if price went to 750, you're going to own at $800. You're going to own it at, 798, 75 because of that initial credit spread. Or actually, let's do this. Let's go back to the platform really quickly. If I just did a naked put, so if all I did was sell a put, I can collect $5.60 on that put. Okay. But check this out. If you can you see the font on my charts? It's pretty small, but if all I did was sell the put and I can collect $5.50, my buying power is reduced. And this is a margin account, but my buying power is reduced by $48,000. Okay. My max profit on this is I need price to stay above $800 and I can make $550. So my max loss is if the stock goes to zero, okay, I collect my $550 because let's just do one contract. So I collect $550. Look at my max loss. My max loss is if this stock goes to zero, I am on the hook for all of that. And I sit here with an assignment at, $800. Right. So the credit spread, like you said, I think cushioning is a really good phrase. So the 795, what it does is I just want you to just pay attention to these numbers here. Look at the max profit versus the max loss and versus the effective buying power reduction. Watch this. If all I did was add the spread, now we go from a buying power reduction of $415 versus $48,000. We go from a max loss of $79,000 to a max loss of $420 with a profit instead of being at $550. Now it's at $90. Now it's it's $1. So there's trade-offs, right? There's pros and cons, but if you think about trading, what's the most important thing to manage? Your risk.
So the less money can be made on this, but it reduces how much you can lose and like the probability of losing.
Exactly. So let's take this full circle because you asked a great question, and I want to make sure that traders understand this. And again, I go back to this. We do this all the time in my trading room. This happens to us when stocks are selling off. We do get assigned, and there are instances where yes, I'll take the stock, and yes, I'll own the stock, and yes, I'll flip the stock. Meaning, if we do this and I let the stock drop, and I have that long put that helps me protect profit along the way or lower my cost basis, I could take assignment. And then when the stock goes up another, $2, $3 and maybe the next 1 or 2 weeks, I'm up a couple dollars per share. I can just close it out, take my profit, walk away. Right. But so, I mean, think about if SMCI drops a ton, and let's just say it did this hypothetically, if the stock does this, it drops like crazy to just a simple Fibonacci number like the 236. Let's say it drops right there. Right. And I can ride that thing all the way down. And I'm about $3 or $3.50 off of that break-even price. And then the stock jumps up here, $30 to $40. I can still make money on that trade if I can handle the assignment, if I have the cash and the buying power to handle the assignment. In the event that I don't, this is what's really important. And this is a great lesson for traders to know. You put on the credit spread because you define your risk. That's the most important reason to understand. This is why we do it. I don't want to take a position that's going to cost me, $75,000 in cash. That's a huge chunk of my portfolio. I don't want that. I will gladly risk, the $300 to $400 on the trade. Okay. But what happens is if the market sells off, if the stock sells off and you get assigned this, and this is something you can't control. We trade American options. They can be exercised at any time. If you trade European options, they are only exercised at the day of expiration. We trade American options. I trade American options. So I can get assigned anytime. Okay. Typically when I get assigned, it's when the stock price is going against me. So if this stock was dropping, what might happen is I get assigned at $800. I have my credit spread. I have my long put that is running. Okay. If I do not want the stock, and this is going to be another little text box here. Okay. If I want the stock, then see the situation up here. If I want the stock, I do this. Okay. I close out the long put and I let the assignment sit. I've taken my credit spread credit. I've taken my long put credit. I know that my effective break even is 753. And now I take my chances. If I think the stock goes up from there, I sit on it. If I wanted to buy more protection, Frank, I can also just buy another put on that position to make sure if it goes down lower, I can keep lowering the cost basis. I could also sell a covered call and try to collect some premium and lower it. So there's ways we can effectively lower our cost basis if we want assignment. But a lot of times, that's a lot of money to tie up in a stock. That's a lot of risk to have on the table if you don't really want to take that type of assignment. So if you want the stock, you do that. If I don't want the stock, or I can't afford to keep the stock, then if this happens, so if we're assigned to $800, it's the same process. We still collected the $1.25 on the credit spread, and we still close the long put for, and I don't like the fancy word like intrinsic, extrinsic, but we close it for the real value, right? Which is the difference between my long put was at $7.95. If the stock price is trading for $7.50, I at least have $45 of real value in the option. Okay. So I'm going to close it as close to that real value as possible. Sometimes we get a little bonus on that depending on time, but we'll close it for the real value. And that's going to be $45. Okay. Now, once you take your $45 long put off the table, now you close the shares. Okay. And you're going to close those shares for $750.
As soon as you're assigned?
As soon as you're assigned and you're like, I want to get out of this, you close out your long put, you close out your shares, and that number should be roughly what you initially risked on the trade. So let's do the math right here. Okay. If I get assigned to $800, okay, I get assigned to $800. I collected my $1.25. Okay. I collected my $45 on the long put. And let's say that I close out my shares at $750. So that means I have 100 shares long. I close them out for $750.
So you lost $375?
Yes. And what is my initial risk on the credit spread?
$375. So
it's the same.
Your break even would be $750.
Yes. So if you did this where you closed out your long put and you close out the long put and close those shares at the price, the stock price is $750, you don't lose anything more than what you initially risked on the credit spread. Does that make sense?
Okay. All right. Yeah.
So that's the only thing that's tough to navigate is and here's what's going to happen. There are examples that I've had where, I'm trying to think of an example. I was in like Alibaba and Baidu and some of these China stocks where I was taking like a $2.50 risk. I closed the long put and I closed out the share price. And because sometimes we get extra premium on the long put side, I actually reduced what would have been like a $2.50 risk on the initial credit spread. I closed out for a loss of like $2.10, $2.15. In this case, as long as you close out that long put and close the shares at $7.50, if it's $7.50 or higher, you're reducing your risk, right? My initial risk was $375. If it's $7.50 or higher, that's your max risk or less. If it's and with a stock like this, it's volatile. If you close out the long put and the shares keep dropping, it's like, oh fudge, I didn't close it until $7.49. I didn't close until $7.48. Well, that's another $1 of risk that you're taking. So ideally, you try to work it where if you close out the long put, you're trying to time it where you're closing out the long put and the shares to know that you're not taking any more risk than what you initially had. Okay. That's where you're just trying to figure out, if I'm doing this together, close out the long put and the share price so you get what you need and you're filled at the right spot. And then it's no different than what your initial credit spread was. Okay. Make sense?
For the most part, yes.
For the most. How about this?
Follow along.
You want to do another example just for fun? Give me a stock. Give me a stock you've been following, or an index. I don't care. But indexers are expensive. This stock is ridiculously expensive. So give me a stock you've been tracking or following. Let's talk about it.
Let's do. I like this small stock. I don't know how the options chain will be on it, but it's AEHR.
AEHR. Oh, let me go to, hang on a second. There we go. AEHR. Is this it? Test Systems?
That's it. Mm-hmm.
Okay. We're trading at 1797. We've got 280K volume, so it's a little on the low liquid side. Next earnings in 50 days. Market cap, 515 million. Let's take a look. AEHR. AEHR. Okay, so a couple things that I discovered right away. We've got earnings coming up on April 4th. We have monthly expirations instead of weekly. So that's part to do that it's inexpensive, part to do with a lower volume. It's not a super liquid stock with only 200 and some thousand shares per day versus 1 million. But let's talk about it. So is there a price point, Frank, that you'd like to own AEHR?
Yes.
Okay.
Let's say 15.
15. Okay. Couple ways to tackle that. So Frank wants to own this at $15. So Frank wants to own it at $15. I think that if we did this, so earnings is on April 4th. We have an expiration on March 15th. The way that I would play this personally is I don't want necessarily the earnings volatility to be unfavorable for me. So if I went out to this March 15th expiration and I want to own this thing at $15, here's actually a pretty simple trade, Frank. I could do a $15 naked put and I could collect 40 cents. So if this is a one contract trade, again, take a look at this. This is always important. If I took a $15 sell put, my max profit's going to be $40 if nothing happens. If the stock price stays where it is at $17.93 and it goes to expiration, I'll keep that $40 credit because it's 40 cents with one contract. So it's 40 cents times 100. That's my $40 max profit. My max risk,
you said, or selling a put?
Selling a put.
Okay.
Yep. So this would be a naked put. So you put in a sell put at 15, collect your 40 cents. As long as price stays above $15 by expiration, I collect that income. Okay. Now, if it's just the naked put, my max risk is going to be the $15 assignment minus what I would collect on that put. So there's my max risk at $14.55. My effective buying power that's reduced is $787 because it's a margin account. So it cuts it in half. Instead of risking $1,500 on the stock, it's going to be cut in half as a margin account. But if I had an IRA, it's going to be cash on cash, which is I'm taking the full $1,500 risk. So here's a couple ways that you could play this, Frank. You could do the naked put at 15 and collect your 40 to 45 cents and be confident that, maybe the stock price stays where it is. Maybe it goes up a little bit. I'll just collect the income. Okay. If you think like, well, I don't want to risk, $1,400 if it goes to zero, which it probably won't. But even if it goes against you to $12.50 or 10, think about this. If it goes to $10, would you still be interested in owning the stock?
Yeah.
Okay. So if you're interested in owning stock at 10, how about this? Let's put on a spread and do a 15 by 12.50. Okay. Now, what's interesting is this is a $2.50 spread, right? So 15 and 12.50, that's $2.50 apart. What does it show that we can collect here? 37 cents. Now, this is where credit spreads for me, this is where I do a lot of the math. I'm not that happy taking a trade like this. That's actually it's a higher delta. But if I did, 250 on the credit spread, 250 on the credit spread, and I collect, 37 cents credit, what's my max risk?
Wait, say that again. Sorry.
Yeah, it's okay. So if I've got a spread at $2.50 and I collect 37 cents on that credit, that makes my max risk $2.13. Is that correct?
$2.30 because you're subtracting 37 cents. Okay.
Yep. So 250 minus 37 is 213. So that means that if price stays above $15, I collect the 37 cents and I'm good. But what I want you to look at here is just, again, pay attention to my max loss is 217. Okay. With that, and that's with the commissions, but it's essentially that's my max risk. My buying power is reduced by $213. Again, a lot different than a max risk of $1,400.
It's a much better situation risk wise. But
absolutely,
when you do these credit spreads, I've only seen you sell a put higher than
buying the puts.
Yes, but also they're right next to each other. Is there any way to sell a put at 15 and then buy a put at 10?
Absolutely, right there.
What does that do to the risk?
So now look at the difference here. So if I sold the 15 and I buy the 10, I collect. This is interesting. I think that the spread's a little wide here, but if I'm looking at the bid price, if I sell the bid, I should be collecting 40 cents. If I buy the ask, the spreads are wide here. But what this should be doing, this is what's interesting. My risk here maximum is going to be $2.50, and then you just take away the credit that you earn on it. If I do it here, I'm not really getting paid additional premium for taking the extra risk. Okay, so let's do this as an example. Let's look at the 20 by 1750, because this should be a little bit more reflective of what the real option looks like. So if I did the 20 by 1750, check this out. That's a $2.50 spread. I can collect $1.55 on that. So let's do the math on that really quickly. Let me increase my font in case that wasn't big enough the first time. And I'll show you the difference. So if we do the 20 by 1750, that's a $2.50 spread. Okay, it shows that we can collect $1.50 credit if we take this trade. Okay, what's your risk on that then?
95 cents.
Yeah, so you actually can make more money in reward than risk. But the risk here is the stock is trading at $18, and I need the stock to go up to $20 in order for me to collect that full profit. So that's essentially considered an in the money credit spread where I need price to go a little bit more in my favor. Okay. Now let's take this. So you can collect $1.55. This will be pretty nice to see. If I increase my spread to $5, okay, now I have a $5 spread. Look at the example here. Now I do a 20 by 15. So that's a $5 spread. It shows that we can collect $2.39 credit. What's my max risk here?
Difference is 2 point something, 6 or 7.1, 2.7.
It should be, is it 6.1? Yeah, 261 max risk, right?
Yeah.
Yeah. So you can see the trade-off is I can go a little bit wider. I can collect more premium, which is nice. I can collect $2.39 versus $1.55, but now my risk has changed. Yeah, my risk changed. That's all.
Okay.
So you can absolutely do this. And so I'll give you an example. I have a couple of these kind of, these out of the money credit spreads. So I did one on Tesla. Okay. I did one on Tesla and I went out about 60 days on Tesla. And if you can see this on my broker platform, the SMC, I was just being weird this morning, but this is my expected move in Tesla. And so all I did was I look at Tesla. We're trading at 185. I went out to the 150 by 145. I sell the 150. I buy the 145. That's a $5 spread. I can collect 60 cents. What's kind of nice about this, and I'll kind of wrap this all up here. Probability of profit's 83%. That means that if the markets just kind of remain the way they remain and there's implied volatility and all these things, that can change. But right now, as the trade sits at this current market condition, this is an 83% chance of making money. Okay. Now, my max profit is $61. My max risk is $4.39. But am I comfortable taking this trade where I think I can collect with 83% probability? I can collect that 60 to 61 cents.
But that would be $61 per contract, right?
Yes. So if I did a one contract trade here, my max profit's going to be $60.
Okay.
Right. If I do a one contract trade, that max profit is $60. My max risk is $4.39. So if I increase the quantity, if I do two contracts, now it says my max profit's $122, but I just doubled my risk now to $878. Maybe that, maybe you're uncomfortable with like the $1,000 risk. So go back here. If you're comfortable with this risk reward profile, it's an okay trade. Now, why do I do this? I believe that for Tesla to drop from 185 to 150, let's look at that from a percentage standpoint. This stock has already been in a ridiculous drawdown, has it not? So we had this huge drop from high to low. That was a pullback of like 70%, wasn't it? Yeah, 75% pullback. We had this rally. I look at this recent drawdown. So from the highs to lows right here, we're still sitting at like a 55% pullback and correction on Tesla. So if we drop another from current price at 185, if we drop down to 150, Tesla has to drop another 20%, another 19, 20%. I know that Tesla's, it's not really Tesla. It's Elon Musk. That's who you're trading with this right now. I mean, it's a bit of a wild card, but longer term, I think it's an automaker. It's disrupting the industry. It's a tech company. It's a battery play. It's EV. All these things could be good and kind of, to me, flipped a little bit more optimistic. But because we've been in a deep sell-off, it's like, even if we just go sideways, Frank, if we go sideways, they still make money, right? So here's where the trade-off is. If I want to do Tesla here, I'm not making a ton of money on the trade, but I'm trading with a high probability. If I wanted to make more money on the trade, I'm like, you know what? I think that Tesla's going to go up from here. If you believe that, then do this. Trade the 185 by 180 and look at the difference in credit now. I'm closer to the real price and the real stock price. I'm much more, getting higher values for my premiums. And so if I sell the 185 put, I buy the 180 put, I now collect 235. If I'm right, all I need price to do is stay above 185, and I collect this full credit. What's my risk on this trade, Frank? It's
Say
a five
spread again.
It's a 185 by 180, so it's a $5 spread, and I can collect about $2.35 credit. So what's that make my risk?
265.
Yep, that's it. So if Tesla drops all the way down to 150, my max risk here is $2.65. If Tesla stays where it is, or gets above 185, and it's at 184.90 right now. So if it stays right where it is, I'll make a little bit of money. If it goes up above 185, I'll make all this profit. If it goes up to $200+, I'll make all this profit. If it drops to zero, I know my max risk.
Okay.
Right. So you don't need a lot of direction to play credit spreads. You just need to establish a line in the sand. That's what's nice about it. If price stays above this level, or stays where it is right now, or goes up or goes down a little bit, you have that line in the sand that tells you, am I full profit? Am I not? And one thing to remember is most options expire worthless. So knowing that, if you're a seller of options, we want options to expire worthless. That's what we're trading for. We want time to work in our favor.
Okay.
Options 101 crash course, Frank.
Thank you for the lesson.
I'll send you the certificate.
Yes. And I will be I'll watch this live stream over and over again.
Yeah.
Taking notes.
Look, you can reach out to me anytime, man. I'm happy to walk you through it. I think with what you guys do at A1 Trading and Nick as well, it's like, if I could get you guys a little bit more well-versed in options trading, or if I can help be a part of that, like, there's so many great ways to position trades, and it's all about risk reward and just understanding what the pros and cons are with these setups. But this is how I manage my portfolios. This is the easiest way for me to define risk and make sure that everything is very simple, right? What's my probability? What's my risk? What's my reward? And just it's number of occurrences. I will take thousands and thousands of trades like this, knowing that there's a much more defined risk this way. With everything, just it's very efficient, which I love.
Yes, I agree that after seeing what you're doing, it makes a lot of sense. I just never really dabbled in this because of, the amount of capital I have, and knowledge of stocks or options and stocks is very limited and risky. So that sort of thing has always been on the back burner, but thank you. Like I will definitely, I want to work together with us and you, and I'm glad you're going to be on the live streams more. So
sure,
we can always talk, and thanks for saying I can always reach out, because I just might. So
yeah, it should. I mean,
argue with questions.
No, it's totally fine. And I get it. Like, I know that it's an overwhelming and intimidating learning curve for options, because there's so much of like the language, the vernacular, the definitions, the graphs, like all of it's a lot to take in up front. But if I could help you understand it today, and it's like, that makes some sense, I'll rewatch it a couple of times. You get the concept of credit spread. All of a sudden you expand it into, okay, there's credit spreads, then there's debit spreads, right? And then there's so many ways to just be like, this is what I would ask you. What do you want to do with the price? If you want price to go up, there's ways to trade that. You want price to go down, there's ways to trade that. You don't think price is going anywhere, there's ways to trade that, right? So literally up, down, sideways, there are strategies that you can make money. Just real quick before we go, we could wrap it up here in a couple minutes. Okay. So I did a trade with my traders this week. We looked at the SPY. We're trading at 496. Let me see if I put the trade on here in Tasty. I'm pretty sure that I did. If I go Tasty positions, it's a SPY trade. I did a SPYs and Qs. And again, this is not to overwhelm anybody, but I'm looking at a position that all I need price to do is get to over the next 2 or 3 weeks. If price gets back above $500, okay, if price continues to fall and gets down to 487, right now we're trading at 496. So if price goes up $6 or $7, I'll make money. If price goes down $9 or $10, because we had a little bit of a bounce from the low yesterday, I'll make money. Now, what's cool about this trade, the ones that I put on yesterday, the put side has a 13-to-1 reward to risk. If I'm right, coming up to expiration, there's a max profit for me of 13-to-1. This was a 10-to-1. Now, I told traders that the probability of us making 13-to-1 or 10-to-1 is slim to none, because in order for that to be made, I've got to be spot on with my price the day of expiration and towards the end of the day of that expiration. That's a lot to ask, and that's a very small probability. But if over the next 3 weeks of trading, price gravitates into this window. So what I did is I established a range. Here's where current price is at 496. What I said was this: if price comes within this little range to the downside, or comes within this range to the upside, if price, let me put this in, let's go like green. If price gravitates up, okay, and it comes into this window, that option that I put on, it's a butterfly spread. If I put on that option trade, it's probably going to trade for 2, 3, 4 times my risk, way before expiration. If price were to fall, and it comes inside that window, same type of thing. I might not grab 10 for 1 profit, but I could probably grab 3, 4, 5 to 1 profit.
Okay.
Yeah.
So you're hoping for not any change, really?
I need price to drift, right? If the CPI stuff is like the turd in the punch bowl and the market's not excited about it, then we might drift a little bit lower. If the market's like, yeah, whatever, it's just a sell off and it's going to be a buy the dip, the market's going to drift higher. Worst case scenario is the market goes nowhere. Okay. My risk is so small, I'm risking less than, my entire risk here is less than $100 on both trades. So I'm risking $100 to make anywhere between like $500 and $1,000 if I'm just right on a little bit of a drift.
Okay.
So again, this is what's cool. What do you want to do with your trade? If you want to go nowhere, there's ways to position for that. If you want to go up or down, there's ways to position for that. And there's ways to craft these trades where you can go, equal risk reward. You can go unfavorable reward to risk, or you can go very favorable reward to risk. And as you would imagine, if you have very favorable reward to risk, your probability is not always that high. If you go very unfavorable reward to risk, your probability is probably high, right? So like, think about this, like it's always a trade-off. I've taken thousands and thousands of option trades. There are very few that I can think of where I'm like, man, this is an advantage for me to take this option trade. It's always pretty efficient. It's always pretty fair. You just have to know what you want to do with the stock, right? That's what's cool. It's like the options market is your sandbox. You can play with all these strategies to figure out, if I think the stock's going up or down or sideways, I'm going to make money. That's what's nice. And what I do a lot of, Nick, you're Frank. What I do a lot of is I will position trade 1, trade 2, trade 3. I'll position for all of it. So if it goes up, down, sideways, I can lose, I can win. And I walk away profitable on, I could lose 2 trades out of 3 and still make money. That's how I trade a lot, because I'm willing to sacrifice, to be right, I'm willing to sacrifice that as long as I just make net profit with a very high probability.
Where did you first start learning about all this?
Part of me was doing it from, so I managed a stock club with my brother. We had about 15 people in our little investment group. And so when I was doing like passive investing and a lot of stock trading from like 2000 onwards, once we turned the corner after the great financial crisis, I started learning more about options to protect our portfolio, which makes sense after you have the market drop 50-some%, right? So after the fact, you're like, I wonder if there's a way to protect our portfolio. So I learned about, just buying a put against your ownership. So if I own 100 shares of something and I buy a put, I can protect that with any type of, insurance policy. So it went from just protecting the portfolio to then realizing that there's this whole world of income generating strategies with options. And that's what I do now. I don't want to own a lot of stocks because it ties up all my buying power. I want to just take trades with calculated risk, 1%, 2%, 3% risk for a given week. That translates into 1%, 2%, 3% profits with high probabilities. Translates into maybe, asymmetry where it's like 5%, 6%, 7%, 8% reward if I'm right on some of these trades. So when I started to study more of the income generating strategies, what I discovered is you have to be a seller of options. If you want to generate income, you're selling options for the most part.
Right.
Yeah, because you give yourself a lot of chances to win that way.
Okay.
So it's been the last like probably 6 or 7 years that it's been very active in this, helping me for portfolio management, you know, and I do, I mean, look, I manage money in Forex and I manage money in stocks and options. I've made a lot more money consistently in trading options than sitting in like, and I'm an investor in Forex. So you have to remember, I'll sit in positions for like a year before I get paid. So it drives me crazy, but like I get paid a lot of money when I'm writing Forex, but I will sit and wait and build. And there's a whole methodology that goes with that. But with options, it's week to week, it's every couple of weeks, it's month to month. And it's just craft my trades and trade probabilities.
Okay.
Yeah.
Well, that's very interesting. I never thought about selling options before I talked to Nick about it, who's doing it recently, and then hearing you sort of give me a crash course. It just makes sense because I have taken options plays before, and you know, like what you said, most options expire worthless, and that's like what would happen to me. So I would think that at some point I was up. Sometimes I would close out early on like naked calls or puts, but if I held on to it, I'd always lose money.
Yeah. Yeah. And long options are, and look, I do long options. I mean, this week would have been great. In fact, my better trade this week would have been if I did a long option from I think I showed this on the session on Monday. If I did a long option, it would have cost me like $6.70 to go long the SPY at like 502 and long the put. So it's a long call at 502, a long put at 500, but it's essentially like right there where price was at on Monday. If I did that and I did the 502 and the 500, both longs, price moved all the way down to like 490 yesterday, which means my $500 put was worth $10. I only paid $6.70 for the option. So that would have given me about a $3 profit. But I wanted to have a higher probability. So I capped it. So now I'm sitting here and, you know, if price is above like 505 or price is below 496, I'll make $1.50. But my max risk went from, you know, $7 to like $3. So anyway, there's all sorts of stuff, but I really mean it. Like I'm genuinely making an offer for you and anybody day one trading. You guys want to crash course in options? It'll make you better traders. It will make you think about the market differently. It'll make you think about how you trade your stocks and options portfolio, and it'll make you think about risk reward and Forex as well. It really is just, it puts it all out there where everything's on the table for when you trade it, this is what has to happen. And you just trade probabilities and efficiencies. It's really cool.
Very cool. Thank you as well.
Yeah.
I really appreciate the offer and, you know, just reaching out because I will definitely hop on that. So
cool.
Well, I think we'll probably have to call it here, I guess.
That's fine. Yep. We can wrap it up. It was a great little Valentine's Day crash course. How's that?
Yeah, it was. I genuinely learned a lot, and I really am going to keep watching this live stream, and I'll probably send you some questions.
Do it. So you know how to get hold of me.
All right. Hey, guys. It's me.
What's up, Taylor?
I've been listening the whole time.
He's like, cut it off.
All right. Well, Chris, I really appreciate you coming on. Frank, you did a great as well. Kind of moderating and bringing in the questions. And, yeah, that was great. That was awesome. It's cool that we were able to do that, even with Nick not here. So that was awesome. Chris, I guess we'll see you next time. This is going to be like a regular thing now. So, yeah, for the rest of the week, we have early shows for the rest of the week. So we'll see you next week. But we look forward to it.
All right. Sounds good. Well, thanks for letting me be on again, guys. It was fun. This is a good way to kick things off, and looking forward to many more sessions.
Yep.
All right.
Thank you, Chris. See you next time.
All right. See you guys. Take care.
Frank, same goes to you. I'm going to close out the show. You're free to go. And I'll see you in a second when you come out that door.
Sounds good. All right.
All right. Okay, guys. Thanks for watching the show. I just wanted to say before we log off, we are doing a 35% off Edge Finder sale. Emily's been dropping links to it this whole time. So we are planning on raising the price eventually. So if you want to get the Edge Finder before before the price goes up, you can grab it 35% off. And after you buy it, all the updates are free for you. So I'm going to drop the link one last time, and that'll close out the show. So thank you guys for watching, and we will see you next time.